the next problem. The following book and fair values were available for Westmont Company as of March 1st. We've got here the book values of Westmont and the fair values of Westmont. Arturo pays $4 million cash and issues 20,000 shares of its $2 par value common stock for $50 a share. So 20,000 at $50 a share is what? $20,000 shares at $50 a share is $1 million of, pays $4,000 cash and issues 20,000 shares of its $2 par value, so that's another million. For all of Westmont's common stock in a merger, after which Westmont is going to cease existing as a separate company. So basically we know that we're going to take all their assets minus their liabilities and bring them over to Arturo. Stock issue costs amount to $25,000 and Arturo pays $42,000 for legal fees to complete the transaction. Prepare Arturo's journal entry to record its acquisition of Westmont. Okay, so there's a couple things you need to know about here. One thing is costs related to stock issuing isn't going to be an expense. It's going to go against our capital costs. But other fees, such as legal fees, will be an expense. Okay? But anything related to stock issue costs, we need to subtract from our common stock. Just so you know that. Again, guys, remember that. When I tell you these things, I'm telling them because you might see it again. If I don't talk about it, you're not going to see it again. But I want you to know which are expensed in the period and which do not get expensed but reduce the equity section. Okay? Issue stocks will reduce the equity section. So we see here Arturo's paying cash and they're issuing common stock. So we need to start with this journal entry. So we are going to report this journal entry. What are some things we know? I'm just going to start with some things I know here. I know the cash was how much? $400,000. I know I should start with all my debits and then present all my credits, but guess what? I don't do it that way. Sometimes I just take the things I know and stick them on there, okay? Do any of your other instructors do that? I'm doing it just because I'm showing you my thinking process, okay? I know cash was $4 million, right? And I also know they issued common stock of how much? How many shares? 20,000. And what's the par value? Common stock, 20,000 at $2, right? You said $2, right? Yep. So that par value is how much? 40,000. But what did they really buy or purchase the company for? 20,000 shares at how much a share? $50, wasn't it? So the difference between the $50 a share minus the $2 par is put into paid-in capital. So 20,000 shares the 20,000 shares times 48 bucks a share is going to paid in capital, isn't it? And that's 48,000 and 480 and 480,000 is 960,000. Okay? So those are the things we just know we're paying for this company. Okay? Now, what's next? Let's go and look at the fair values. We're showing inventory at 600,000, land at 990. Because guys, we don't care about the book values, do we? We have to show fair values. It honestly doesn't matter what the book values are. We report it at fair value. So inventory of 600, land of 990, buildings of 2 million, customer relationships of 800,000, and the accounts payable is a minus 80. So we need to put that information in here, okay? So we're going to start with inventory of 600. What is our land? Our building is 2 million. Customer relationships? Goodwill? How are we going to calculate this goodwill? The other thing we need to show here is our accounts payable we're assuming is what? 80. So when we figure out if we bought the company for 5 million, so the consideration is 5 million, right? Then we take into account the fair values. So I'm basically going to do all of these, okay? Then I'm going to do minus the accounts payable. See what I'm doing here? So I'm basically taking, we paid 5 million for it. 4,000 cash, 4 million cash, $1 million in stock. We need to calculate the assets we receive. Now, if there wasn't this accounts payable there, we would just take the fair value of all these assets. Okay? But since we're assuming a debt, we want to subtract that out of our fair value. Make sense? So we take the 600,000 plus the 990 plus the 2 million plus the 800 minus the 80,000, and we have the net assets at fair value are 4,310,000. The difference of 690,000 is what we're paying more for the company than the net assets we're getting. So wouldn't that be the goodwill? So we will add something in here shown as goodwill . $690. See how we calculated that? We need to know what we are buying this company for. We need to subtract out the fair value of the assets minus the fair value of the debt to come up with a balance. The difference is going to be goodwill. Now, the next part says, use the same facts. Let me make sure I did all that right. Prepare Arturo's journal entries to record his acquisition. So that is the first part of it. I screwed up. There are 2 additional items we need to show. One is we need to show the legal fees, okay? And then the other is to show the stock issue costs. So the legal fees can be treated as an expense. It's either a legal expense or professional services expense, however you want to record it. And this is a credit to cash. Now this is not the tricky one, but the one I don't want you to forget. What do we do with the stock issue costs? We have to offset this into additional paid-in capital. We can't write it off as an expense. It's a cost of issuing the stock, and we offset it against the stock, okay? So we keep the par value where it is, but that money we paid above and beyond the par value, that additional paid-in capital, we're going to offset it there. So we're going to debit additional paid-in capital of $25,000, and we're going to credit our cash of $25,000. Any questions on that? That's a new piece. If you have a multiple choice that says stock issuance costs were of $50,000, what do we do? How do we journalize this stock issuance cost? If you have an example that shows an acquisition expense of $50,000, credit cash, it's going to be wrong, right? Because it's not an expense, it reduces our paid-in capital. Okay? So guys, I'm telling you everything you need to know. But there's a lot to know. So that's why it's helpful to write this down or to listen to it again. How you guys doing? Next, number 21. We're going to use these same facts, but assume instead that Arturo pays cash of $4,200,000 to acquire Westmont, no stock is issued. So I'm going to cheat a little. Okay? So I know they're going to acquire $4,200,000. I have one too many zeros. And I'm going to delete this. Okay? So what happens here? Our consideration is $4,200,000. Do you see how our fair value stays the same? But look, guys, what's happening here? We paid less than the fair value of the assets, right? This is a bargain purchase. We paid only $4,200,000 for this company, but we received in fair value $4,310,000. So there's no goodwill here. We've got a gain. So we will then show a gain on the bargain purchase. Does that make sense? Okay.